The S&P 500 tumbled by nearly 6% on Thursday in its biggest one-day drop since the 16th of March. That's the fifth drop of more than 5% over the last 3 months. Concerns about a second wave of the coronavirus, combined with a weak outlook from the Fed, is weighing on equity markets. So is this a short-term blip or the start of a bigger correction? Joining me now is Bill Blain. He's a strategist at Shard Capital. Bill, great to chat to you. What did you make of the moves in the US market on Thursday? And are you using this as an opportunity to buy the dips?
Well, it's absolutely fascinating what went on yesterday, and I'm not sure that it is a buy the dip moment. But let's take a look at what happened. We got some really bad news in terms of the outlook for the virus. We were seeing looks to be a second wave. The actual truth is we're months away from a second wave. All we're seeing just now is the first wave of the virus filling in the parts where it hadn't already hit. And then, of course, you had Jerome Powell, who very helpfully for the markets told them that he's going to keep interest rates close to zero till 2022, but more importantly, continue with QE infinity. But what he also said was he did expect the outlook for the US economy and employment to remain very difficult. And on these two things, the Fed saying that the outlook for the economy is bad and the coronavirus threat, suddenly the market took fright and sold off. But is that going to be continued? Well, there are a couple of reasons to doubt it. And the first is, of course, the ongoing influence of QE infinity. Now, this is the way that the Fed is in buying bonds, keeping interest rate low. But that has a knock-on effect. And one of the areas it impacts, of course, is stocks. In fact, I'd go as far as to say, if you're looking for inflation as a result of quantitative easing, you don't have to look very far. It's all in stock and bond prices. And just think about it for 1 second. 10 years ago, before QE, the yield of a bond was around 5%. The global economy was looking in serious trouble, but then we had interest rates slashed to near zero, as we say, ZIRP, and a bond now yields about 1%. So in other words, a bond yields 1/5 of what it yielded 10 years ago. In the stock market, we're seeing effectively the same thing, where a company that its stock was $1 10 years ago, let's say the price is now $10, but it's still making exactly the same profit it was 10 years ago. So that's where all the inflation is buried. All the cash has flown into financial assets, and that's what's keeping them all so high, because there's nowhere else for that cash to go just now. Just think about the news stories you've read this morning about the real economy. They've all been extremely negative. Nobody is putting money into the real economy, buying property, building factories, or buying ships or aircraft. They're all sticking it into financial assets. I'm sorry that's a long-winded way of saying it, but it's the inflation in financial assets that means we're unlikely, in my opinion, to see a major correction occur at the moment. I do think, however, that the economic news is going to get much, much worse, and predictably worse, because we know that we're going to see Q2 earnings starting in July, and when they come through, they are going to be brutally dire.
Okay, so do you think that that sort of disconnect between the underlying weakness in the global economy and the strength in asset prices can continue? And if you don't think that that makes sense, like I don't, do you think that one of those things has got to change?
Well, you're absolutely right. There is a massive disconnect, and it doesn't make much sense. And it has also profound consequences, because it means that an awful lot of the money that government is creating to rescue economies from the coronavirus threat is simply going into financial assets. That means it's going into very few hands. It's going to raise income inequality and all the other inequalities that the world is now so concerned with. So it doesn't seem to be sustainable. But the thing is, governments and central banks have very little choice but to do this. They know a recession is coming, and they simply cannot afford the double whammy of a stock market, financial market collapse at the same time. And we're not just talking about stocks here, we're talking about bonds, we're talking about companies that are now massively over levered. If they start to default and go bust, that's going to cause another financial crisis. So, this is part of the same pretend and extend game that we've seen going on for 10 years. And you know what? I completely agree with you. It should be unsustainable and it doesn't make much sense. Unfortunately, central banks and governments have very little choice but to continue it. And this is going to be one of the major debates of the coming 20 years. How do we undo the damage that it's done?
Yeah, I mean, some of the damage is coming through in the growth figures. We had the UK's GDP today fall by more than 20% in April. Obviously, the economy very badly hit by the coronavirus. I guess the question really is what sort of recovery are you expecting, not just in the UK, but globally? Because there seems to be kind of two schools of thought out there. Some are the optimists who are looking for a V-shaped recovery. And then you were talking about us kind of potentially still weathering this or considering the sort of knock-on impacts of this 20 years down the line.
Yeah, I mean, you're absolutely correct. How is it when the UK economy is warning of a 20% decline in April, yet the stock market has reacted by climbing 2%? Clearly, that makes no sense unless there is some massive distortion underway. But that distortion is underway. It's inflation, and it's also all the money on the side that was waiting for the chance to buy the dips coming back in. And there is, of course, another factor which we're calling the Robin Hood army effect, which is the fact that with US sports stadiums all being closed and all the horse racing cancelled, there's nothing else to gamble on except stock accounts. So we are seeing an enormous number of day traders and retail investors going in and trying to get rich by buying the market, which is why we're getting such crazy valuations overnight.
Okay, so where do you think some of those opportunities are? What are your kind of key stock picks right now?
Right. Well, there are some very interesting opportunities out there. The approach that I've taken is very much which stocks, because every company in the world is going to be hit by the coronavirus, but which are likely to see orders simply delayed rather than being completely lost. So we know that the airlines have completely lost orders that they would have had this year. In other words, people aren't flying. But we are also seeing long-term problems for them in terms of how long will it take to reopen. Now, there were opportunities there, even with airlines where we know the picture is terrible. It became quite clear that the market had oversold. That's why companies like Ryanair staged some spectacular rallies as we started to see a faster reopening of regional travel. It's not going to happen globally for a long time, but there were games to be played regionally in airlines. But I'm thinking about some of the tech stocks. So think about Microsoft. They look very attractive just now because one of the key things we're seeing there is a massive growth in the cloud, the use of the cloud by companies that have had their staff working at home. Apple was also doing very well because, you know what, if you can't buy an iPhone for the next couple of months, you're going to wait till the store reopens. You'll still buy it. And they're innovating their own gear into that ecosystem. Clearly, names like Amazon make sense as well, but so does Tencent in the States as delivery companies. So there are some solid stories out there. But at times like this, when we're seeing enormous exuberance in the market, you also get crazy stories. And I'm thinking of this truck maker in the States, Nikola, it's called, named after Nikola Tesla. And there's the connection, an electric truck. They have not, at this stage, built or sold a single truck. But their stock market valuation is 31 billion, which is more than Ford. You know what? Ford sells literally millions of trucks every year and makes a profit on them. Yet this company hasn't sold a single one and is worth more than Ford. That's crazy.
So where do you stand then on Tesla? Because we know this is a stock that really kind of divides the bulls and the bears. Which camp are you in?
You know what? Tesla is a fascinating stock. Let's give them credit for what they've done. They have completely reinvented the auto sector and created the whole electric vehicle sector. Everyone thinks that Tesla is some kind of massively innovative and world-changing stock because it's done that. Then you say, well, hang on, what is it that Tesla's actually done? All they've really done, and I know that someone's going to jump in and say, what about autonomous driving? What about making your car work for the 90% of the time you're not using it? That's all somewhere in the future. It's not important today. I buy stocks on the basis of what I can really see. But what Tesla has done is basically replace the gas tank in your car with a ton of batteries that sit on the floor plan. And these batteries are all built out of lithium-ion batteries, which are very heavy. They are efficient, but it's a 50-year-old technology. So don't tell me that Tesla is new. They're using 50-year-old technology, which is also, by the way, extremely dangerous because lithium does burn. And also, you cannot recycle it. And because it's a chemical reaction that's occurring, after 5 years, Tesla batteries, like any lithium battery, will need to be replaced. But it's this recycling thing that's the real issue. Imagine if you had a new battery technology. Imagine if somebody looked at the whole way that we store energy and created a whole new form of capacitance. And there is such a model. It's called carbon ion battery technology. It's very clever tech, and the UK leads the market in developing it. But that tech is lighter and is capable of being fast charged. In other words, instead of waiting for an hour to fast charge your car, it will take 5 minutes. But more to the point, you don't need to build the batteries as a block that sits at the back of the car. It could be built into the structure of the car, making it lighter. And this new battery technology will come in the next few years. Now, I will give Tesla full marks for innovating the electric vehicle market. I will give Elon Musk minus infinity marks for his very poor standards of corporate governance. But I will not pay a penny for thinking that Tesla is going to dominate the electric vehicle market forever and ever. At some point, new technologies, and the one I've just highlighted in carbon ion batteries, is going to knock Tesla's current lithium battery position out the market. That means everyone else is going to come in and design cars based around a new battery system, and it will very quickly replace Tesla. That said, I have driven one. I was favorably impressed. If someone was to offer me one to try for a month, I'd be delighted, and I might even buy one. Who knows? But I won't buy something with Elon Musk's name on it.
Bill, thank you so much for your answers and for your time. That was Bill Blain, strategist at Shard Capital. I'm Victoria Scholar, and thanks for watching IGTV.